program is the Active Center.
Hey there, and welcome. Every single year, millions of us go through the ritual of filing our taxes. But have you ever stopped to think about what the single most important number on that entire return actually is? Well, today we're going to pull back the curtain and demystify your tax liability, what you actually owe, and more importantly, how you get to that number. Let's dive right in. So, let me ask you this directly. When you're looking at all those forms and all those boxes, what do you think is the most critical number? Is it the total salary you made all year? Maybe it's that refund you're hoping for? Just think about it for a second. All right, you ready? The answer might not be what you think. It's not your gross income, and it's definitely not your refund. The single most important number is your total tax liability. This, right here, is the bottom line. It's the figure that really matters, the one everything else is built around, and it's exactly what we're going to break down. So what exactly is it? Well, to put it simply, your tax liability is the grand total of tax you're on the hook for. That means everything you owe to your local, state, and federal governments. Now, for today, we're really going to zoom in on the federal part, the portion that the IRS collects. And you know, this total liability isn't just one single thing. It's kind of like a bucket filled with different types of taxes. You've got your standard federal income tax from your paycheck, for sure, but you might also have capital gains tax if you sold some stocks, or self-employment tax if you're a freelancer. And yeah, it even includes any back taxes or penalties from past years. Now, I know this can all sound super complicated, but honestly, it all boils down to a pretty simple fundamental formula. First, we figure out your taxable income, then we subtract any tax credits you can get, and voila, you land on your final tax liability. This is our roadmap for the next few minutes. Okay, so let's kick things off at the very beginning of that roadmap. Before we can figure out what you owe, we've got to figure out how much of your money the government can actually tax in the first place. And it all starts with your income. Think of this as a three-step journey to refine that number. First up, you have your gross income. That's the big one, every single dollar you earned. From there, we subtract some specific adjustments to get to your adjusted gross income, or AGI. And then finally, we subtract your deductions. And that gives us your taxable income. That's the number we really care about. And that brings us to the first major decision you get to make to lower that number, your deduction strategy. Seriously, think of it like coming to a fork in the road on your tax journey. You've got a choice to make. You've got two paths. Path one is the standard deduction. It's a simple, fixed dollar amount the government gives you, no questions asked. The amount just depends on your filing status. Path two is to itemize your deductions. This is where you add up a whole list of specific eligible expenses. The goal? Just pick whichever path gives you the biggest number and saves you the most money. So what kind of things are we talking about when we say itemize? Well, some of the really common ones are interest you paid on a mortgage, the state and local taxes you paid, you'll often hear that called the SALT deduction, any money you donated to charity, and even major medical expenses, as long as they're more than 7.5% of your AGI. Okay, so once we've used deductions to shrink our taxable income as much as possible, we get to bring out the big guns. This is the final, and I mean most powerful tool you have. I honestly think of these as the ultimate power-up for crushing your tax bill, tax credits. Okay, now this is absolutely crucial to understand. What's the difference? Well, a $1,000 deduction is great. It lowers your taxable income by $1,000. But a $1,000 credit? Whoa, that's a whole different ballgame. It reduces your final tax bill by a full $1,000. It's a dollar-for-dollar reduction. And that's why you'll always hear tax pros say this. It's simple, really. Credits are just way more valuable. Deductions chip away at the income that gets taxed, but credits deliver a direct knockout punch to the final amount of tax you actually have to pay. It doesn't get any better than that. Theory is one thing, but let's see how this all works in the real world. To do that, we're going to follow the stories of two people, Janie and Peter. They both start out with the exact same income, but as you'll see, they make very different choices along the way.
First up, we have Janie. Her adjusted gross income, her AGI, is $125,000. She's taken a look at all her expenses for the year and decides, you know what, I'm going to take the simpler path.
So Janie takes the standard deduction for her filing status. That knocks a cool $24,800 right off her AGI. This brings her final taxable income down to $100,200. That's the amount her tax bill will be calculated from.
And now for the power-up. After the initial tax is calculated, Janie gets to apply a $4,000 child tax credit. And remember, this is a credit, so it comes right off the top of her tax bill, bringing her final tax liability, the money she actually has to pay, down to $9,624.
All right, now let's turn to Peter. He's starting in the exact same spot as Janie, an AGI of $125,000. But Peter has been meticulously tracking his expenses all year, and he decides to take that other fork in the road.
Peter adds everything up: his mortgage interest, his state taxes, his charitable giving, and it all totals $28,000. Now, since that's a lot more than the standard deduction, it's a no-brainer for him to itemize. This brings his taxable income all the way down to $97,000, which you'll notice is already lower than Janie's.
And here's the payoff. Because Peter started with a lower taxable income, his final tax liability comes out to $8,920. That is over $700 less than what Janie paid, all because he took the time to itemize his deductions. It really shows the power of making that choice. So after watching Janie and Peter's stories, the big question is, how can you apply these lessons? Well, it's all about building a smart tax strategy that's tailored specifically for you and your financial life. So let's quickly recap the key strategies. First off, look into ways to get tax-free income, like through a health savings account. Next, always maximize your deductions. Do the quick math to see if itemizing makes sense for you. Third, and this is a big one, hunt down every single tax credit you might be eligible for. They are literally money in your pocket. And finally, look, if things start to feel overwhelming, don't be a hero. Talk to a tax professional. And there you have it, the journey from your gross income all the way down to your final tax liability. It's not some big secret. It's a roadmap. It has clear choices and decision points at every turn. And now that you understand the power of deductions and credits, you have the tools to navigate that map effectively. The only question left is, how will you choose to navigate it?